Hello everybody and welcome to this new video where I keep going with my review of inexpensive stocks, especially after the crash we had. This video is titled 8 stocks too cheap to ignore, or there are some stocks that are too cheap to ignore. And so to remind you how I do stocks on this channel, I have 3 buckets. I cover stocks that are absolutely the best growth businesses outside of valuation. There's a bucket of stocks where I don't look at all of the valuation. Whenever I talk a Tesla, whenever I talk about Palantir, I haven't talked about Palantir in a while, but whenever I talk about these stocks, I entirely ignore valuation. That's my bucket number 1, where I ignore valuation and I just buy the best regardless of price. That's one style of investing. Another style of investing that I do on this channel is pure USD debasement plays. This is anything that I do related to Bitcoin. So MicroStrategy, Marathon, any of the Bitcoin miners, similar. Whenever I talk these stocks, I'm interested in these stocks mostly because of it's a debasement play, because it's going to beat the denominator, because we're not based on the US dollar. We're not using the US dollar. We're using another asset to underlie the performance of the stock. And of course, many of you may have been attracted to my channel through my pure debasement plays. And number 3, bucket number 3 is good growth stocks that are mostly interesting to me because they have a very low valuation. This is the growth and value orientation of my channel. This is growth at a low price, not even a reasonable price. This is growth at a low price, and this is what today's video is about. The stocks that I'm talking about today are growth at a low price. And of course, the cornerstone, the corner metric, the top metric in this bucket number 3 is enterprise value over gross profit over revenue growth. As a reminder, if you're new to the channel, enterprise value, why do I use, first of all, what is this? EV over GP over RG. That's my switch from the PEG ratio. I took the PEG ratio, I modified it for my style, for my preference. So the PEG ratio of Peter Lynch, modified. That's what the EV over GP over RG is. Why do I use EV? Because it's better than market cap. Back in the 80s, people used market cap because that's what you had in the newspaper. It was tougher to calculate enterprise value because you needed to go back to the report, look at cash, look at debt. Enterprise value is better because the company that have cash, that's subtracted from the market cap, and if you have a lot of debt, you add it to the market cap. So you penalize high debt companies and you help out companies that have a lot of cash on the balance sheet. Enterprise value, I believe, is a better metric than market cap. Why do I use gross profit and not earnings? Well, earnings are here to pay taxes. Companies optimize their earnings. They want them low. They want low earnings. Why do they want low earnings? Because they want to pay less taxes. That's point number 1. But gross profit, why not operating profit, right? Why do I use gross profit specifically? Well, this is because of the debate that was all started by Amazon in the early days, which is especially marketing. What is marketing? Is marketing an expense or is marketing an investment? I consider that for most companies today, most companies of the 21st century, marketing is an investment in the future, especially if you have a company that has recurring sales. And so I don't want to penalize companies for spending on marketing. I want them to spend on marketing. I want them to spend on R&D. And I'm even fine with SG&A. Why? Because if you attract the best managers, the best teams, the best engineers, that's going to cost you more money, but that's an investment in the business. So anything under the gross profit line, I typically consider it an investment. So that's why I use gross profit, and that's why I don't use operating profit. And of course, revenue growth. This doesn't change from Peter Lynch's PEG ratio. This is the same thing, except I use revenue growth and not earnings growth. He uses earnings growth. But the reason why I use revenue growth, the theory is the same, is if I value stocks on a price to sales basis, if the sales go up and the price to sales ratio stays the same, then the sales going up should be your return on the stock, provided that the price to sales ratio does not contract or does not expand. And so I think it's a fair way to assess stocks and to really adjust them for the growth. So I've had a lot of success with this metric over the years. I love this metric very much, and that's how I'm going to assess which stock is a better deal, which stock is less good of a deal. And I also add in my spreadsheet, and by the way, it's a very long spreadsheet. I have over 200 stocks. You can get it on the Patreon. Another thing that I do, of course, is EBITDA, right, and the rule of 40. So I want them to be EBITDA positive because I don't want them to go bankrupt on me. So EBITDA is my proxy for cash flow. I want them to be EBITDA positive, and then I use the rule of 40 for every stock, not just software stocks. This is a base. This is something that got started with software companies, but the return of software companies has been so good that I think it's fair to use it for any company, and I want them to have a rule of 40, i.e., I want the revenue growth and the margin, the EBITDA margin, to be above 40. And then in that case, not only do you have a profitable stock, but you also have a high growth stock. And you can see if it's cheap based on enterprise value over GP over RG. So rule of 40 is a nice addition. An addition I started adding to the spreadsheet about a year ago. Okay, let's get started with the stocks. Which stocks are cheap? LifeMD and Hims. I love both stocks. I've been a lover of LifeMD, of Hims on this channel for a very long time. Started talking about Hims more than 2 years ago now. So Hims has been an amazing performer at $45, not quite a 10x, but almost a 10x, right? When it was trading near the 70s, that was a 10x for Hims. I think Hims still has a lot of progress to go. It's not just a GLP-1 play. They are going into all sorts of businesses in healthcare. This is the revolution of healthcare. This is a vertically integrated healthcare offering. Hims is what? It's an e-doctor plus an e-pharmacy without insurance. Removing insurance allows them to gain customers, allows them to charge less, allows them to move faster, and I find Hims still pretty cheap at a 0.13. It's still pretty cheap. Historically, this stock has been trading under 0.1, so it is still a little more expensive than what we're used to. But when you consider everything, it's still pretty cheap, and the stock, of course, is way up. But once again, when a stock has grown revenue by, I think it was 69% for Hims, when they've grown revenue trailing 12 months this much by 69%, it's fair for the price to also go up by 69%. Now, granted, Hims has grown a little more, so we've seen a valuation increase for Hims, an increase in the valuation. It's a little less undervalued than it used to be, but it's still fair. The company is 69% bigger today than it was 12 months ago. And for LifeMD is a similar story, but LifeMD is a much cheaper stock. You can see the market cap of LifeMD is 230 million versus almost 10 billion. So I consider LifeMD right now to have a better 10-bagger potential than Hims, or at least a quicker 10-bagger potential than Hims. I like LifeMD very much. LifeMD is a little more advanced than Hims as far as the doctors go. LifeMD is a subscription for doctors. It's a monthly pay, $39 a month, and you get one doctor visit, one office visit a month, and they have all sorts of customers. LifeMD is attractive to people who have chronic issues, like if you have diabetes, etc. You need to see the doctor often. Having a subscription for $39 a month, like you pay for Netflix, you have a doctor subscription. That is a very compelling case. LifeMD is getting into the pharmacy business. They bought a pharmacy. They have a thriving GLP-1 business. The main difference between LifeMD and Hims is that LifeMD goes through insurance for the pharmacy benefits. They try to get you qualified for, in the case of GLP-1, a GLP-1 via your pharmacy benefits, and they sell branded GLP-1. So that's a key distinction between LifeMD and Hims. Of course, as far as the spreadsheet is concerned, the keyest distinction of them all is that LifeMD is more than 3 times cheaper than Hims if you look at EV over GP over RG. But if you remove Work Simply, they have a $50 million business that is unrelated to the telehealth business that they've been trying to sell. If you remove Work Simply, if you assume they sell Work Simply for $50 million, which they should at some point, if you assume that, then you have a stock that is not only cheaper, but you have also a stock whose revenue growth is faster, closer to the 50%. And LifeMD even becomes trading in the 0.02 EV over GP over RG. So in that case, you're a good 6 to 7 times cheaper than Hims. So I am loading up on LifeMD right now. My position in Hims is, of course, very full. It is my third largest position right now. So and I own both stocks, right? LifeMD and Hims, I own both of them. Let me move on to other stocks that I find, quote unquote, cheap, maybe too cheap to ignore. Disclaimer, I don't own any of these two. I don't own Gigacloud, and I don't own PinDuoDuo. And that's because, like many investors, I've been burnt on Chinese stocks before, and I am in the process of reassessing whether I should touch Chinese stocks again or not. Now, Gigacloud is incorporated in the US, but a lot of people associate it with a Chinese stock, and a lot of people say, oh, well, this is a Chinese stock because it imports a lot of stuff from China. PinDuoDuo is a pure Chinese stock, so both of these stocks are cheap. Enterprise value over gross profit over revenue growth for Gigacloud Tech is a 0.16. For PinDuoDuo, it's a 0.12, so PinDuoDuo is slightly cheaper. Maybe that has to do with the fact the premium that Gigacloud Technology is incorporated in the US. Nonetheless, I think both of these stocks have suffered recently due to tariff fears. It's worth mentioning that PinDuoDuo is a little back up compared to Gigacloud, which is pretty much trading at an all-time low. People who follow insider movements, they'll be pleased to see that actually there's insiders buying the stock at Gigacloud. What is Gigacloud? Gigacloud is a drop shipping platform. I mean, there's probably a better way to say it, but it's a platform for sellers of bulky items, mostly furniture, but over big items. If you sell furniture online, if you sell furniture on, you have your own website, or you even sell furniture in a physical store and you want to get it delivered straight from China to the consumer, this is where Gigacloud comes into play. And they've had good growth lately. Of course, the main attraction for Gigacloud is how cheap it is. You can see on my metrics it looks cheap, but on enterprise value over forward revenue, that's a 0.7, so under a 1 times sales. This stock is trading at under a 1 times sales. You can even look today, right? They have 940 million enterprise value, and their sales were 1.1 billion. And even if you look at traditional, TradFi metrics, the kind of the silly P ratio, kind of this dumb metric that I consider the P ratio to be, is trading at a 5.3, a 5.3x. So again, cheaper than a pharmacy or a car manufacturer about to go bankrupt for a growth firm. So I don't understand why it's so cheap. PinDuoDuo is the same story. There's no denying, in my view, it's trading at 11 times price to earnings ratio. So PinDuoDuo is very, very cheap, but there's no denying that PinDuoDuo, has, created a lot of damage in e-commerce because of Temu. Temu and Shein, if you follow this sector, they are the two biggest shopping apps out there, besides Amazon and besides your local Amazon-like business. They are huge disruptors. They're disruptors to the point that both the European Union and the United States is talking about removing the exemption, the emerging country exemption of tariffs for goods that are less than $800 that are shipped straight from China to Europe and shipped straight from China to the United States. There's an exemption right now in the International Postal Code that exempts companies like PinDuoDuo, or you could say AliExpress, etc. is kind of the same thing. TikTok Shop is of the same thing. They thrive because of that exemption. Europe is upset because the small businesses in their malls and in their downtowns are going out of business to Shein and to Temu. And in the US, they're upset not necessarily because the small business are dying. No, the small business have been long gone here. That's not why they're upset. They're upset because they don't pay the tariffs, and of course Donald Trump wants to put tariffs on China. So this is why this is a stock that I think is under turmoil. But there's no denying that their PinDuoDuo, which they translate as together, more savings, more fun. The way I translate that when I covered the PinDuoDuo before on the stock is shopping together with friends for fun, or shopping for fun. It's the recreation of a digital mall or the digital bazaar. It's recreating the pleasure of discovering an item and the pleasure of shopping for an item, a little bit like you would do in a market in the real world. And they've created these shopping apps that are very, very addictive in the case of PinDuoDuo. So to me, there's no doubt if PinDuoDuo was in the US, it would be trading at a much higher valuation, and it would be considered a disruptive big tech company, but it is still very, very cheap. I don't own either of them. This is a question mark. This is always a question mark, less of a question mark right now when we have very, very cheap stocks like LifeMD. When we had a crash in the market this past month, there's a lot of deals right now. But if we move to a market, say 3 or 4 months from now, where the deals are gone, this is something that I would look at again. Anyways, not invested in these, but I find them cheap. They may be too cheap to ignore. Now, talking about 2 stocks that I own, SoFi and Nubank. And that's exactly what I said earlier when I said there's a lot of good stocks out west that are also very very, very cheap. Well, that's the case of SoFi and Nubank. The valuation of SoFi and Nubank historically has been neck and neck. They've both the valuation I've found very similar historically. They both are major disruptors in their field. Nubank is further ahead in its disruption than SoFi because SoFi is fighting incumbent banks, right? They're fighting the JP Morgan of the world. Nubank is fighting cash. Nubank is going after the unbanked in Latin America. So in many ways, Nubank has grown to much bigger proportions than SoFi. But as far as valuation goes, it's uncanny. It's a 0.17 for both. And even the rule of 40 is above 70 for both stocks. I own both stocks. Nubank has dropped. There's always some concern with currency movements in Latin America. I don't understand this drop for Nubank. The company is still growing very, very fast. And SoFi has dropped. You see how uncanny it is. It's dropped 19%. It's dropped 22% from the peak. I believe, just looking at the chart, I believe Nubank is probably a slightly better deal right now than SoFi, but SoFi is also a very good deal. I own both stocks, and I find them deals, and it's really uncanny. Like I said, they grow at about the same speed. SoFi gross margin is a little higher than Nubank, but calculating gross margin for a bank is not really the way you do it. Their income statements are much more complicated than your traditional commercial company just selling goods. So it's perhaps not the best way to look at it. You can see their EBITDA margin are much more similar. So again, similar stocks, different regions, different areas. I like them both very much. I find them both very cheap on my spreadsheet as 0.17. Moving to stock number 7 that I'm covering here today, which is Celsius. So Celsius was a question mark. Was it 9 days ago now? 9 days ago, Celsius, when it was trading at $22 a share, that was a big question mark. Because we didn't really know if the Pepsi inventory slowdown was actually real. Actually, Pepsi got overconfident and ordered too much. We didn't know that, and we didn't really know if they were suffering from competition from Alani, and both clouds on the horizon just went away. The only thing that didn't go away is the cheapness of the stock. The stock is still cheap. Okay, it spiked up to the mid-30s on the day of the announcement because it became very obvious to the market that the risks had been not entirely, but mostly gone for this company. And then it just dropped back down as if we had forgotten about the good news. Now, of course, this is no financial advice. Yeah, it's a risky company. It's a small cap, etc. But to me now, when I look at this company, the risk is mostly alleviated. You're looking at a company whose sales are growing in a very challenging environment for convenience stores, for retailers. The growth in the category comes mostly from Celsius at this point in the energy drink category. They grew their sales 22% year over year, sell-through at the stores. Only 3% if you look at their income statement. Why? Because Pepsi messed up. Pepsi over-ordered too early, too soon, and they had to order less. But what matters for this type of company is the sell-through, and the sell-through at the stores is healthy, as evidenced whenever you go to a convenience stores, to a gas station, to a Walmart in the US. These products sell, these shelves. If you like a specific flavor of Celsius, the odds are your flavor is not going to be on the shelf. If you go on Amazon and look at the bestseller in energy drink, it is Celsius. So to me, the thesis is intact on the Celsius brand, the Celsius beverage. And of course, this company was fearful that Alani was taking a lot of sales from them, especially from a Gen Z female consumer, when now that growth is gone because they are buying Alani. They're paying 1.8, I think without the cash, it's 1.6 billion for it. So they are buying Alani in a big acquisition. That acquisition will close in Q2 of 2025. Acquisitions, I'm usually wary of them, but 1 billion-ish, 1.6 billion, A, that qualifies as a small acquisition in my book. And then B, here you're acquiring your biggest competitor. I listened to the full call. In the full call, they didn't make it seem like it was their biggest competitor. Yeah, you bet it was their bigger competitor. If you looked at the top 3 energy drinks, top 3 brands among Gen Z, Alani was number 1, Celsius was number 3. You can see Alani, they disclosed this. Alani was growing at 50% year over year. Celsius itself growing at 33% year over year. They're going to be combined companies. How fast are they going to grow? I don't know. Is it going to be 38%? That's kind of what I estimated. Them growing at 38%. I left it at 34%. 34% is what the analysts say they're going to grow, but they may grow more than 34% over the next 12 months, thanks to that Alani acquisition. The gross margin, the EBITDA margin is very much in line. 23% for Alani, 18% for Celsius. So that is in line with a 20% EBITDA margin that I have in there. So similar profitability, similar business, makes a lot of sense. Similar amount of synergies, right? Celsius invested a lot in a distribution center called Big Beverage. I think it was in Tennessee or something. So they're going to have some synergies there. It's getting Celsius more into the pre-workout and powder business thanks to Alani, because Alani has a pre-workout business, and I'm assuming they're going to have some of the learnings from Alani. They're going to be able to bring them on to Celsius, so you may get a Celsius pre-workout powder, etc. This acquisition makes sense. It's rare that they do, but in my view, this acquisition makes sense, mostly because you're taking out a competitor, and that's the big deal here. You're taking out the competitor. So, anyways, and of course, their point of sale distributions just to show, and this is a highlight from the call. I didn't cover the call on the channel yet, so this is a highlight from the call. Their point of sales is plus 37% year over year. So there's 37% more locations in the US where you can find Celsius than there were a year ago. And notable additions include Subway. So Subway, of course, it's a brand that's kind of in a turnaround story, but they still have tons of locations. I mean, Subway's litter Americans strip malls, and when it comes to the Home Depot, they made it to the Home Depot. This is a huge deal. When you go to the Home Depot, they have Red Bull, they have Monster. For the longest time, they didn't have Celsius. Now they have Red Bull, Monster, and Celsius. The energy drink world situation is looking like it's gonna be a trifecta: Celsius, Red Bull, and Monster. And if it is a trifecta, and if in, say, 5 years, 10 years from now, Celsius has 1/3 of the market, then in my view, this company is way undervalued, and I'm happy to own it. This is a stock that I own. This is a stock that I've been adding to, and I look forward to adding more to it at this valuation, 0.22. It's still cheap. And finishing up the last stock that is too cheap to ignore. This stock hasn't moved in 3 weeks. It's been 3 weeks now since I published this video right there about the stock hitting the $69 price. And it went back up in 75. And then, of course, risk-off period. It got sold off because it's in the bucket of stocks that's considered risk stock by money managers. I cannot understand the overreaction of this market. Yes, they still make a little under 80% of their makeup in China. However, if you look at China, first of all, you may notice that the tariffs that are earmarked for China are 10%. They're not 25% like Mexico or Canada. 10%, a company like ELF can survive. ELF survived 10% tariffs back in 2018. How did they survive it? 3% concessions from suppliers, 3% margin drops, and then 3% price increases. That's how they dealt with it. A company like ELF can deal with 10% tariffs. Furthermore, ELF has been doing a lot of work trying to manufacture the makeup outside of China. That is point number 2. Then they are selling in Europe. They are selling in Mexico. This is a company that is becoming more and more international, that is trying to sell outside of the US. So this is not just a US-centric story anymore. This is not just a Target-centric story anymore, like this stock might have been construed as 5 years ago, even though they are still the best-selling brand at Target, and I'm sure a lot of women still buy ELF from Target. This company is doing very well. They are gaining share. They are gaining traction in a category that is losing steam. You can see the cosmetics category is down 5%. ELF is up 16%. They have now the second share in dollar spend as far as mass cosmetics go in the US, and they have the number 1 share in units sold, 14% of units sold. The consumer is getting smart. The consumer is not paying $30, $40, $50 for lipstick anymore. They're fine paying $8, and this brand is really compelling to the Gen Z, to the younger millennial, to the future soon-to-be generation Alpha, and they're buying this product. And so I've added a lot to this stock recently, and I'm happy to own it, and we'll see where it goes. I consider it to be a great company, actually, when I look at the number, and the 0.22. I'm not paying that much for a brand that is well rooted in the sector. Revenue growth looks like this. The revenue growth, in my view, is fine. They're predicting, so they'll close their FY 2025 next quarter, so they're predicting between 27-28% growth next quarter. And I have them for next year, so 5 quarters from now. I have them at 20% revenue growth. That's what I put in the spreadsheet. In there, they could do much more than that, but analysts seem to be very, very negative as to the revenue growth of this company. I think they are too negative. I think this company may be a winner for the short run, and especially when you consider the stock was $200, near $200 not too long ago. This is a market overreaction in my view, and I'm happy to be scooping up some shares at these levels. So anyways, these were 8 stocks which may be too cheap to ignore. This was not financial advice, not investment advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe. Follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.